Yeah, so what do you even think about where the private lending game is going to end up with all the whole real estate stuff? Just the real estate market in general, like how's that getting affected with the private lending stuff?
Well, I mean, it depends which aspect of it. There are a few different things to consider. Like one thing that I hear people talk about, it worries me a little bit, and we'll see how it plays out, is, you know, the guys who are putting out, you know, a loan here and there, they're amateur guys, they have some money in an IRA or whatever it may be, and they lend to people they meet at the RIA and everything else, and when you talk to them about their deals, man, they don't know how to underwrite a loan, and they don't have a checklist, and they take the borrower's word for probably more than they should. They just don't paper a file the way a professional lender would. And when the market cools a little bit, I'm worried about those guys. I'm worried about those guys taking a hit because they don't know what they're doing.
Yeah, I think they're going to be the first ones to go. And, you know, the last 5 years, they were fine because the market would save them. But the market's not going to continue to save people anymore. As of right now, if they have a deal and that's in default right now, chances are, like, that deal is screwed. And I mean, we see it all the time. You know, we quote a loan for 130 because we think it's worth 200, and they're like, yeah, I'm going to go with this guy, this private lender is going to give me 165. And, you know, it's bad. It's just bad all around. And, you know, a private lender like that, that's a lot of money. If it's in a self-directed IRA, or even if it's in cash, like, they lose that and they're out. Like, it's
for sure.
You know, it's a tough gig. And, you know, I look at that on two sides, though. I don't just look at that as irresponsible as the private investor, but there's also some risk when it comes to the borrower, the client who's raising the private money. Number one, obviously raising the money the right way, but more importantly, like, you know, when you go raise money, number one, it's not the easiest thing. It's not like people are just giving you money, right? So you have to go spend the time to do that. The second thing is the person you're raising money for needs to have the same goals as you. Your goals need to be aligned. You have to treat them as like a partner. I mean, you know how it is. You bring on capital from the wrong type of investor, they're just going to micromanage the hell out of you and ask for status updates. Oh, what'd you do with this? What'd you do with this? What'd you do with this? Like, you don't want a boss or a babysitter when you're doing this project. But I also think that the worst aspect that could potentially happen if these you know, real estate investors don't raise money from the right private capital investors, is what happens when a deal starts going bad and they lose money. Yeah, the private investor's gonna be pissed off, and then they're gonna point fingers at that investor and try to sue them. I mean, if the last thing you want on a project that's going bad that a real estate investor is losing on is having your partner, your capital source, trying to sue your ass.
Yeah, without a doubt. I mean, they could, in raising money in that way, instead of borrowing from a professional lender, like, they could be setting themselves up for a bad situation.
Yeah.
Without really knowing it. And granted, like, there's a lot of pluses, a lot of pros to having your own private capital and structuring it how you want.
The right private capital.
The right private capital, but like you said, a lot of those real estate investors don't understand that they're taking on the job of investor relations, which is a real job. You know, no matter if the private investor is micromanaging you or not, I think it could definitely be a job that you didn't intend to pick up.
Yeah. And I think, you know, in the private sector to begin with, I still think the ones that are going to lose the most are these really big capital sources, these big, that used to be hard money lenders similar to us that have taken on institutional capital, or they've just really tried to scale, and they're in the volume game. They're lending out cheap for very little margins. These are that are appraisal based. I mean, how do you do a private loan that's appraisal based? I mean, that's like me going to flip a house and then going to an appraiser and be like, hey, what am I going to sell this property for? Like, that's the wrong person to ask. And, you know, if you're an experienced real estate investor, you're going to laugh about that. If you're a new real estate investor and you don't get this, or you don't get that, you need to tighten your game up and understand these property values, because you can't rely on somebody else to do this. You need to be the one that's figuring that out. Oh, hey, real estate agent or real estate appraiser that has no vested interest in this transaction, tell me, you know, what I should buy. I mean, that's like, you know, going to whatever, a neighbor, and be like, hey, what stock tips should I buy? Like, what should I invest in? So these big institutional lenders are going to get themselves handed to them if they're not careful. And I mean, obviously they're smart, right? These big banks got to be smart to put money on the streets. But at least what I see, they don't look that smart. You know, there are other ones. You know, we'll quote a loan, maybe say like $400,000 in like Petworth in in Washington, D.C. The borrower needs 80 grand cash to close, which is a pretty decent deal on both sides. It might be worth 600 grand, that asset. And some of these larger companies that are appraisal based are like, yeah, this thing's worth 700, not 600. We'll give you a 75 or 80 LTV based off of that. And it's like, the borrower doesn't need any money at the table. Like, you got to watch out. Like, those guys are going to be the first ones to go.
For sure. And I mean, you're right. They are smart finance guys, banks and institutions, and they know what they're doing to some extent. But hey, it certainly wouldn't be the first time that an institution took a hit on getting too aggressive in real estate lending. And like you said, the most important number in the whole transaction is what that collateral is worth. And you're putting that power in the hands of somebody who has no vested interest in the deal.
That's right.
Like, that's pretty crazy if you think about it. They're getting paid $500, $700, whatever it is for an appraisal. And that's it. Then they're out. They have no risks. They have no involvement. They won't even know if that whole deal goes sideways. And they just pass it off to the lender who gave them the power to do that. And it's pretty silly if you think about it that way.
Yeah, and keep in mind with a lot of this stuff, ARVs are typically the most important number in these deals, right? The after repair value to figure out what it's going to be worth when it's done. But listen, we've been involved in 2,500 deals. We know that deals don't always get all the way to the finish line, and you have to sell deals quickly, take back properties. A lot of properties don't get finished. So it's not just the after repair value. It's the as-is value. You have the as-is value, and you have the after repair value, and then you have, what happens on day 30, 60, 90 throughout as time goes by, as the property's getting improved, as construction money's getting reimbursed. Where does that all shake up? And there's no way for an appraiser and somebody from out of state to know those numbers. They just don't. A lot of the times it's just the deals don't make sense. And again, with the market being the way it has been, which is good. And listen, I'm all for a good market. There's money to be had there. When the market can save people. It can save bad real estate investors. It can save bad deals that you accidentally got into. It can save bad lenders. But I strongly believe that the days of appreciation, at least short term, are over, and you're not getting saved. If you get put into a bad deal, if you do a 160 loan amount as a lender on a $200,000 property, that $200,000 property is going to stay at $200,000. It's not going to 210, 215, 220, which is the additional cushion you would need if you write a bad loan. It's just not. It's going to stay where it's at. So that's where all the shakeup's going to happen quickly. So I don't know. That's kind of the way I look at it, and not that I'm biased because we own a hard money lending company, but I do believe that partnering with either a hard money lender or a private lender that's sophisticated, that knows himself, or even a local bank. It doesn't have to be a hard money lender, a local bank that knows local market conditions, that has resources, is just such a good option to do. Or, a friend or family member who has cash that knows real estate as well, another investor, because then you got multiple people looking at a deal. I mean, how many times do we have good, sophisticated investors that reach out and be like, hey, I can't wrap my brain around this project. What do you think it's worth? Type of thing. I think that goes a long way, especially in a volatile market.
Let me ask you a question, and I know there's been a lot of talk about this recently, and everyone's always has their eyes on how tech is influencing different kinds of businesses, not just, online stuff and search and software and all that, but like how tech is influencing other businesses that didn't used to use that much technology. What do you think's missing in terms of technology being able to evaluate the value of real estate?
There's nothing. I think the tech's already in place, but I think there's a human element, just like take Warren Buffett as being a human element for when he picks stock picks. You can go to 3 gigantic firms. If you compare this to the market, to any type of investment, go watch CNBC at 4 o'clock, and there's 4 analysts all next to them, and their firms all own different types of portfolios of what they see fits best for them. So there isn't any. You take that tech, you take all the information you get your hands on, and the way tech works these days, it's great because they have their algorithms are based on realtor data, on public record data, on market trend forecast data between Zillow and MLS systems and some of the other stuff. So the tech's good, but again, you utilize that data, you utilize the information that you can, that you're provided, and then you make a smart decision based on past performance, your appetite for assets, things like that. So, I mean, I don't look at looking at loans or real estate deals any different than Warren Buffett looks at buying a stock or a business. It's the same situation.
So what you're trying to say is that you're the Warren Buffett of hard money lending?
Yes.
Not bad.
Minus a bunch of zeros. I'm not going to tell you how many zeros minus, but minus the zeros. I mean, that's what it is, right? The information's out there. Anyone can get their hands on the information. The tech makes the information easier.
Yeah, and then also, one important factor that you mentioned a lot is that, and maybe the tech can't pick up on this, maybe it can, maybe it factors in other borrower-related data, but, if somebody were to flip a house, all of us were to flip a house, each one of us would exit for a different price because it's based on the work that you do, the product that you can put out, and how good you are at it. Mine would probably be the worst because I suck at construction and that sort of thing. But I doubt an automated valuation model, I think that's what they call those, AVMs, automated valuation model, would factor in how well a borrower can potentially execute or not. Which is a serious factor in our underwriting.
Serious factors, and just because listen, you executed on one project doesn't mean you can execute on the next, and that might not necessarily be. I mean, it's obviously the investor's fault, but there's so many different things that could potentially go wrong. You open up walls and you got to remove stuff you weren't planning to remove. There's just a lot of X factors that happen, so you do the best that you can. And that's why the character and the capacity when we do underwriting is so important. And again, you just use common sense, just like any investment. I mean, keep in mind, a VC firm funds 10 new acquisitions or 10 new companies, startups this year, with the goal that one or two of them hits, knowing that the rest of them are going to be dogs. So there's always going to be default. There's always going to be bad deals. And obviously, the more experience you have and the tighter your analysis and underwriting is, the better they're going to be. So, I mean, tech can't, change everything, but I always look at it as it gives you easier access to the data at your fingertips.
Cool.
Cut.